everyone. This is Vishal from Equity Guru, and welcome to another chart attack video. Let's talk about the equity markets. We will focus a lot on the US side of things, but I just want to show you guys some of these European markets. Everything is pretty much green on the day we're recording on April 6th here, 2023. Germany breaking out here. The UK markets, the FTSE is also seeing a nice retest of a technical zone. We're seeing the Italian markets getting a bit of a bid here as well. The Spanish markets are also climbing up higher. French markets is the one that a lot of people are finding interesting because, look, we're just knocking on the doors to making new all-time record highs in the French markets there. And if we look a bit in Asia, the Japanese market, a bit choppy here, and the Hang Seng in Hong Kong is looking to trigger some sort of technical pattern. So maybe as of now, with a lot of the headlines coming out in the equity markets, I think it might be a good time to sort of focus on, what we've been seeing on the technical charts. And on the day we're recording, you can see here, everything is green. A lot of the fundamental reasons is due to, a lot of this sort of bad data that's been coming out recently with US job openings tumbling below 10 million for the first time in 2 years. And a lot of people taking this as, well, the market's taking this as a sign that the Fed is succeeding in its effort to, slow down that labor market. Don't use that R word, though. Don't talk about, recession. But essentially that their monetary policy is now bringing down or slowing down the economy, which is pretty much what they're trying to do in order to tame that inflation data. And also U.S. factory orders declined more than expected, adding more strength to this narrative of the economy slowing down. Orders for manufactured goods decreased by 3.9 billion or 0.7% in February to 536.4 billion, and this print followed January's decline of 2.1%. So why is this, I guess you could say, why is this bullish for the equity markets? Well, it comes down to the Federal Reserve and the idea that they will, they're very close to pivoting, right? Well, I don't want to say pivoting, let's say pause. Pause is the better word, actually. Yeah, they're close to pausing. We've seen just recently, the Central Bank of Australia also paused. Bank of Canada paused last month. And there's another central bank that paused this month. I think it's one of the emerging market ones. Well, there's South Korea as well. But we'll talk about one central bank near the end of this video that I think could, surprise the markets here. But now the idea is that with the Fed looking to pause and not raise interest rates anymore, that the market is seeing this as, like a bullish sentiment, right? That now we can finally go back into equities because bonds are going to be sort of tapering off there. A lot of the people who want to buy bonds are doing so now at these high rates before, it basically tops. So this money now is going to come back into the equity markets. However, I'll throw in one caveat, which I think, a lot of people are sort of considering, and that is what's going to happen here with oil prices, right? So there was this OPEC plus surprise where Saudi Arabia, the UAE, I believe it was also Kuwait, they decided to cut their oil production, of course, the Russians as well. And because of this, well, we saw a surprise pop in oil, and you can see, how much oil actually gapped up. From a technical analysis perspective, we actually did break down below 72.50 here, and I'm looking at the charts of West Texas, which was a very important support zone here. You can see that oil was ranging basically for 3 months until we got that breakdown. A lot of people saw that as this bearish oil move, and it was, focusing on this idea that the economy is slowing down, recession coming. So that's why oil prices had that break. And then all of a sudden, surprise news, we're back above what used to be resistance, now acting as support once again. And again, talking about the huge gap up, which is very, very bullish. And now the oil markets are just trending here just below 82. I'm pretty sure a lot of shorts got taken out. And now we're going to see if we can climb back above this 82.50 zone. And of course, many of you guys know that oil is the lifeblood of the economy. When you're transporting food and products, you're doing so by, either in trucks or other modes of transportation. And if prices of oil and transportation goes up, then it's likely that the price of food and all those other products will also go up because now, the prices have to go up to cover the cost of increased fuel, which means that those inflation numbers could peak once more. So the next CPI number is going to be, very important for the markets, especially if this oil shock plays a role in, tilting those CPI numbers higher, which would sort of complicate what the Fed is going to do, right? Maybe they have to stick with being hawkish, but very likely they're going to go back to the whole, pragmatic approach where, we'll look at the data meeting by meeting and do what we'll have to do. But as of now, well, again, just from my mouth, but maybe they will put in that sort of the language there, just indicating that they like where the rates are right now, this terminal rate that we've always heard around, 5.1 to 5.25%, but they'll be open to deal with, they'll be open to hike rates if inflation or if data, says otherwise, right? So follow this oil market here because I think this might be a bit of a shock that no one, no one's really been expecting. And that's why we got this gap up, and we'll have to see what this does to those CPI numbers. So again, we have these economic data indicating a slowdown in the U.S. economy, and then we also have this oil pop, which might be a surprise for those CPI inflation. So you can sort of say that maybe the Fed and maybe other central banks are sort of stuck between a rock and a hard place here. I mean, I don't have a CNBC tab, but when you're on CNBC, you're seeing a lot of articles sort of stating about major layoffs, right? So going back to the whole economy sort of slowing down narrative there. If we look now at the major U.S. indices, and once again, the technicals here have been saying that the markets are bullish, even though we have some of this data, which once again, slowing down of the economy, OPEC and inflation. But when you look at the technicals, we have this breakout. And sometimes I think it's good to just focus on the technicals. Although, maybe the market could be wrong here because it's not accounting for all this data, which could set you up for a nice short opportunity when, say, a certain resistance technical zone is going to be tested, which actually might happen here in about, in a few days, perhaps, with a little bump up here. But as of now, the S&P 500, we covered this major trend line breakout. We've covered this wedge pattern breakout. We've even covered this recovery of the 40-40 zone here. And to me, as long as we're above 40-40 here on the S&P, the uptrend is still intact. But keep in mind, major resistance zone is approaching here at the 41.60 level, which will probably be tested next week. And we'll see if the sellers will be able to push prices back down. But if we get a breakout above this zone, that will also probably lead to a breakout above 4,200, which would just be another major bullish sign for the equity markets here. If we take a look at the Dow Jones, I do find this one very, very interesting because we talked about this breakdown, which happened below 32,000, about 600, let's call it. And that was a very bearish sign. The markets pulled back to retest. We even got an engulfing candle there, which looked like it would be very, very bearish. But instead, we climbed and closed back above what used to be resistance, now acting as support once again. So that would mean that this bearish downtrend is now technically over. When you have this false breakdown, that's usually a very bearish sign. But you can see there is a bit of resistance around this 33,750 zone that the markets or the Dow Jones is testing right now. And I'm watching this major zone around 34,400 above. So we'll have to see if we can climb above and break out above that. That would be very significant for the Dow Jones. finally, the NASDAQ, and I saved this one for last because remember, this is the market that is technically in a new bull market, right? Because we have now bounced and we covered 20% from the lows, and it entered or officially entered a bull market last week. And again, the technicals have been telling us that this is still bullish. We are still heading, we still have room to the upside. We talked about this breakout around the 12,600 or 12,700 zone. Currently have a bit of a pullback. We're seeing the buyers are stepping in, and we're seeing this again, in all the U.S. Equity markets. 13,600 is the resistance zone that I have marked up ahead. But as I said earlier, it does look like the S&P is the one that's going to be testing that major resistance before the other markets here. So, I guess in summary, a lot of information talking about the slowing down of the economy. Do have this oil news, which could, see CPI tick higher, which I think would surprise the markets because now, okay, what does the Fed do? Are they still going to be dovish or pause, or are they going to keep the foot on the accelerator there and remain hawkish, which I think the markets would not like. And then you have the technicals here all indicating that the breakouts for all the indices are still in play. We live in this world where everything is sort of interconnected, which is why I focused on some of those European equity indices at the beginning, because they're all pretty much breaking out and are quite strong. So that might be indicating this move back, I guess, or this risk on move here, right? Where money's running back into the riskier assets here, and the fear is pretty much gone. So let me know what you guys think about the equity markets here. I forgot, sorry, one more news that I just want to cover very, very quickly before I let you all go. We're still weeks away, but at the end of April, we're going to hear from the Bank of Japan. And if you guys remember some of my previous videos and also articles, I've been warning about the Bank of Japan and why it could be a big shock for the equity markets because of their bond markets, and how Japan is also the #1 buyer of U.S. Treasuries, and it's because interest rates in Japan and bond yields in Japan have been low. They are the largest savers, in the Western world or Western Alliance world, you could say, even though they're in the East, I know. But a lot of their money goes overseas because of that huge saving pools, and it generally buys a lot of the bonds in, say, Europe and in the US. And if that money does decide to come back because Japanese yields are beginning to rise, that would be pretty significant for, say, the bond markets in the US and in Europe. And, we have a new governor now. The new Bank of Japan governor, Kuroda, is gone. And a lot of people say that this new governor might be ending this whole yield curve control. And that would be a very significant move in the markets. And as I said, the Japanese bond markets could go crazy, which would affect markets around the world. And let's keep in mind, right, while all these other central banks have been raising interest rates, Japan has not been doing so. And, we've seen the Japanese yen just crater against many, many currencies. Seeing, some records being broken on the US dollar, Japanese yen. We are seeing a bit of strength now in the yen, which might be indicating some traders taking positions to factor in I guess you could say, a hawkish Bank of Japan. But that meeting, again, end of April, I think it's just something that you should keep in mind because not very many people talk about the Bank of Japan or think they really matter because they haven't been doing much for the past few years. But things are sort of changing where they might be, as I said, getting rid of that yield curve control. And I've talked about this in previous videos and articles, which I definitely encourage you all to check out. But that's it for me, folks. Let me know if you're bullish on the equity markets here. I really want to read your comments below, and I'll catch you guys all in the next chart attack.